Welcome back to PipsTalk, your go-to source for Forex trading insights. In today's video, we're diving into a powerful trading technique, multiple time frame analysis. By combining different time frames, you can unlock high-probability trading opportunities. Trading with a single time frame can be like looking at a single puzzle piece. But when you combine multiple time frames, you see the complete picture of the market. What is multiple time frame analysis? Before we explore the how, let's clarify the what. What is multiple time frame analysis? The essence of multiple time frame analysis. Multiple time frame analysis is the practice of examining the same currency pair on different time frames. Each time frame provides unique insights into price action, trends, and potential trade setups. This technique allows traders to confirm signals, identify trends, and make more informed trading decisions. The power of multiple time frame analysis. So, why is this technique powerful? 1. Trend confirmation. One of the primary benefits is trend confirmation. You can use longer time frames to confirm the direction of the trend and then select shorter time frames for precise entries. This minimizes the risk of trading against the prevailing trend. 2. Improved entry and exit points. Multiple time frame analysis can help you identify optimal entry and exit points. It provides a comprehensive view of the market structure, allowing you to time your trades more effectively. By aligning multiple time frames, you can pinpoint moments of confluence for high-probability trades. 3. Reduced false signals. False signals are a trader's bane. By incorporating multiple time frames, you can filter out many false signals that may appear on a single time frame. This leads to more accurate and reliable trade setups. The key time frames. Now, let's discuss the key time frames you should consider in your multiple time frame analysis. 1. Long-term time frames, monthly and weekly. The monthly and weekly time frames offer a broader perspective. They help you identify long-term trends, major support and resistance levels, and significant price action. 2. Intermediate time frames, daily and 4-hour. The daily and 4-hour time frames provide a balance between long-term trends and shorter-term price fluctuations. These time frames are often used for trend confirmation and identifying potential entry points. 3. Short-term time frames, 1 hour and 15 minute. The 1 hour and 15-minute time frames delve into shorter-term price movements. They help traders fine-tune entries and exits and spot intraday opportunities. How to use multiple time frame analysis. Now, let's explore how to use multiple time frame analysis effectively. 1. Start with the long term. Begin your analysis with the long-term time frames, like the weekly and daily. Identify the major trend direction, key support and resistance levels, and any important patterns or indicators. 2. Confirm with intermediate time frames. Once you have a grasp of the long-term trends, move to the intermediate time frames, such as the 4-hour. Confirm that the trend aligns with your long-term analysis. 3. Look for entry points on short-term time frames. After confirming the trend, focus on the short-term time frames, like the 1 hour and 15 minute. Look for confluence in these time frames to spot entry and exit points. 4. Use technical indicators and tools. Combine multiple time frame analysis with technical indicators and tools. For example, moving averages, stochastic oscillators, and Fibonacci retracement levels can enhance your analysis. 5. Maintain consistency. Consistency is the key to successful multiple time frame analysis. Establish a routine for your analysis, and ensure that your chosen time frames align with your trading strategy. Common pitfalls to avoid. While multiple time frame analysis is powerful, it's not immune to challenges. Let's explore some common pitfalls. 1. Overcomplicating analysis. Overloading your analysis with too many time frames can lead to confusion. Stick to a few key time frames that align with your trading style. 2. Ignoring the bigger picture. Don't become too absorbed in the short-term time frames. Always consider the bigger picture and the long-term trend. 3. Lack of patience. Patience is essential. Avoid rushing into trades without waiting for confluence across your selected time frames. In conclusion, multiple time frame analysis is a potent tool for Forex traders. It helps you confirm trends, improve entry and exit points, and reduce false signals. If you found this video informative, Please subscribe to PipsTalk for more insights into Forex trading, strategies, and market analysis.